Have you ever pondered what would happen if one of the retail giants suddenly crumbled? Well, brace yourself because Target, once a dominant force in the industry, may be on the verge of collapse. While the pandemic saw their sales skyrocket, the aftermath has been devastating. Inventory imbalances plunged their profits by a staggering 90% in a single quarter, and the supply chain issues persist, causing frustration among weary shoppers who are greeted by empty shelves. The signs of distress are glaring, revealing a rapidly deteriorating financial health. And surprisingly, Target is falling behind smaller competitors across multiple categories. Today, we'll delve into several eye-opening facts that expose the alarming state of Target's financial situation and the factors that threaten to dismantle this retail giant in 2023. But before we dive in, we kindly ask you to support our work by hitting the thumbs up button and subscribing to our channel. First, let's address the staggering loss suffered by Target. In 2022 alone, a whopping $25 billion was wiped out from their market cap. The past 12 months have been nothing short of a nightmare for this big box store chain. Their stock plummeted for 5 consecutive quarters, erasing $25 billion in market value. Investors were left reeling as they digested the retail giant's alarming earnings results, which revealed that annual revenue fell well below expectations. The root cause: a series of unresolved problems plaguing their internal operations and supply chains. This loss represents the largest yearly setback the retailer has ever faced. During what should have been their busiest shopping season, Target's profits took a nosedive, plunging by a staggering 43%. No other major retailer had a more challenging year than Target in 2022. Their profit loss was relentless, with a 52% drop in the first quarter, a 90% collapse in the second, and a 53% decline in the third. The fourth quarter, which typically helps retailers offset losses accumulated throughout the year, only exacerbated the chain's woes. During last year's peak shopping season, Target's profits sank by 43%, the highest recorded among all U.S. retailers. It was a disastrous end to the year, and unfortunately, their troubles spilled over into 2023. Target's stock took a brutal beating as consumer demand experienced a precipitous decline. The big box chain reported an unexpected drop in holiday quarter sales in January, pointing to dwindling consumer demand for everything from toys to computers, furniture, and clothing. Consequently, their shares experienced the third worst single-day decline in history, surpassed only by the infamous Black Monday in 1987 and the 25% crash, triggered by a 90% profit loss in the second quarter of 2022. On January 18th, shares of the retail giant plummeted more than 17%, leaving Target the hardest hit among major retailers. Their product mix, heavily weighted towards apparel, home furnishings, and electronics, forced them to resort to heavy discounting to clear excess inventory. But even with lower prices, shoppers remained elusive. The decline in discretionary demand has been alarming, as echoed by Christina Hannington, Target's chief growth officer. This heavy reliance on consumers' discretionary purchases may spell further trouble for the chain in the months ahead. According to Statista, 2/3 of Americans plan to spend less this summer compared to the same period last year. Target's once thriving apparel business is now crumbling. Since November 2021, their apparel sales have been steadily shrinking, while inventories in categories like fashion remain a staggering 23% higher than the previous year. From March 2022 to March 2023, consumer demand for clothing, footwear, and accessories fell at a concerning rate of 3.5% on a monthly basis. This decline is indicative of a broader trend affecting Target's apparel business. UBS analysts revealed that consumers' willingness to spend on soft goods like clothing has dropped by almost half since 2019, marking the most significant decline since at least 2013. This decline in consumer spending can be attributed to various factors, one of which is inflation. Middle and lower-end consumers are feeling the squeeze of inflation and are beginning to cut back on non-essential items. As inflation continues to impact lower-income cohorts the hardest and first, Target needs to exercise caution when it comes to catering to the lower end of the consumer spectrum. The decline in consumer spending and the erosion of purchasing power are clear signs that the retailer's apparel business is in dire straits. In the past quarter alone, Target incurred a staggering loss of over $664 million. For the quarter ending on January 23rd, the company reported profits of $876 million, marking a decline of 6 pre-pandemic operating income margin rate by 2024. However, while striving to improve its financial situation, the retailer is also allocating $5 billion towards expanding its supply chain network, enhancing digital operations, and improving services. Although this investment may yield long-term benefits, it currently poses a significant risk of accumulating substantial debt, especially considering the company's impending loan obligations valued at $1.7 billion in the coming months. In essence, the company finds itself on the precipice of a precarious situation. Target's CEO, Brian Cornell, is raising concerns about the state of the U.S. economy as sales experience a worrying deceleration. The company's executives are apprehensive about the economic outlook for 2023. During an earnings report in March, Cornell highlighted that shoppers are no longer spending the same amounts they used to at Target stores, which has resulted in a strain on the company's profitability. The prevailing economic conditions, characterized by persistent Target's management informed investors that due to the constrained environment for consumer spending, they were compelled to offer more promotions. Cornell stated that they are planning cautiously in anticipation of economic challenges, which would mark the second consecutive year of significant financial losses for the company. The outlook appears grim amid the ongoing crisis in the retail sector. Wells Fargo recently downgraded Target as an investment for 2023, citing a range of persistent challenges and headwinds. The bank's analyst, Edward Kelly, emphasized the meaningful deterioration in the retailer's outlook. Concerns include the potential for an extended period of weakness in general merchandise, a shift to negative foot traffic, uncertainty regarding the timing and extent of margin recovery, and the return of scalability concerns from before the COVID-19 pandemic. As a result, Wells Fargo advises clients to divest from Target shares and explore other investment opportunities in consumer staples retail brands that are not currently facing significant distress. Target finds itself among the bottom 5 retailers at DISC, along with Kroger, Costco, Sprouts Farmers Markets, and United Natural Foods. If the company fails to strategize during this critical juncture, mass store closures and widespread layoffs may be inevitable. Target is confronted with a unique combination of challenges, unprecedented in its history. Economic indicators suggest that more volatility is on the horizon, necessitating a proactive stance from the retailer. The retail industry has witnessed the demise of major chains within a short span of time, and if Target does not swiftly adapt, it risks succumbing to a similar fate. Thank you for watching.